Modern algorithmic trading relies heavily on deep learning models. These models are exceptionally effective when markets are stable, identifying subtle historical patterns to generate yield. But when a market undergoes a chaotic structural collapse, that reliance on historical stability becomes a critical vulnerability. We call this vulnerability regime blindness. A neural network trained on years of steady growth will look at a sudden, violent drop and classify it as a temporary deviation. It assumes the market will revert to its historical mean, missing the reality that the underlying macro regime has broken down. A pure probability engine calculates what usually happens, not what is happening right now. During a macro breakdown, capital allocation requires an explicit deterministic rule system designed to strictly override probabilistic guesswork. Somasundaram Murugia's analytical agentic AI system was architected to solve this exact problem. It rejects pure probabilistic modeling at the execution layer, replacing it with strict rule-governed logic. This diagram shows the system's multi-layered intelligence stack. Notice that the black box neural networks are placed in a subordinate role. They function strictly as advisory agents, performing pattern recognition and noise reduction, without the authority to allocate capital. The absolute authority sits at the top, the Market Context Protocol, or MCP. The MCP is a deterministic rule engine. It evaluates macro conditions like volatility and has the power to override the AI's probabilistic signals if the market enters a high-risk state. By placing a strict logic gate above the neural networks, the architecture strips away opaque machine guessing. Every final decision is auditable, traceable, and grounded in explicit mathematics. To see this architecture under extreme stress, we can examine its performance on the Nifty 50 index during the second week of March 2026. This data table details the system's baseline parameters at the close of March 9th. Through agent-to-agent sequential collaboration, a process where specialized internal AI models exchange and validate data, the system locked in a compressed volatility of 0.92% and assigned a baseline bearish bias score of -7. These compressed pre-market parameters reflected a deceptive calm. The market was coiled tight, setting the exact conditions required for an imminent structural failure. On March 10th, the index experienced a sharp intraday recovery, producing predictive noise that triggers standard machine learning models to buy. Instead, the Market Context Protocol executed hierarchical governance. It analyzed broader data, identifying the rally as a temporary counter-trend compression, not a genuine shift. To neutralize the predictive noise, the MCP took explicit action. It actively clamped the daily macro score, holding it strictly to a bearish -7, ignoring the bullish intraday signals. This hard-coded clamping acts as a cognitive guardrail. By refusing to validate the false reversal, the system protected the human operator from over-leveraging capital into a doomed position. The next morning, the market opened with an aggressive gap down to 24,231.85. The system's natural language processing agents immediately classified this as a structural breakdown continuation, forcing an immediate pre-market downgrade to a strong bearish -13 state. At 10:32 a.m., the market attempted another recovery, executing a transient bullish mean reversion bounce. A mean reversion bounce is a temporary price movement back toward an average historical level before the primary trend resumes. This bounce triggered the volatility-gated bias control. Because the system recorded that daily volatility had expanded asymmetrically to 1.91%, the Market Context Protocol mathematically refused to allow a bullish shift in the system's bias. The gating mechanism held the line. By the end of the trading session, 98.1% of all logged intraday states were forced to remain strictly bearish. Dynamically tying signal confirmation thresholds to market variance filters out the noise of high-stress trading environments. This creates a defense mechanism mathematically superior to relying on static price indicators. The system tracked decay across overnight closures, locking in a March 12 baseline with a strong bearish score of -19. March 13 began with a violent 0.75% gap down. In response, the system downgrades the bias to a defensive strong bearish -20. The internal timing agents instantly analyze the downward microstructure. As the price fell, they stamped the charts with strict 0.1 and 0.2 deterministic drop identifiers, creating an exact chronological log of the decay. Because the architecture relies on structured variables rather than short-term momentum, it successfully maintained its sequential logic across the overnight gap, requiring zero human recalibration. The system faced its ultimate stress test at precisely 11:37 UTC, when the index executed a violent, sudden upward retracement to 23,387.50. This chart captures the telemetry conflict. Volatility spiked to 1.62%, while raw data registered 19 strong bear signals, calling for immediate execution. Asserting absolute authority over this high variance, the MCP suppressed all 19 triggers, forcing the system into a protective neutral amber state. This amber interface is a calculated feature of behavioral finance. It functions as a psychological guardrail, actively stopping the human operator from executing a trade during a period of extreme, unpredictable variance. Once the false reversal lost its momentum and decayed, the internal agent-to-agent collaboration confirmed the resumption of the trend and deterministically reinstated the breakdown sequence. It did this while maintaining strict non-repainting integrity. Non-repainting integrity is an architectural mandate, ensuring that a system never retroactively alters its historical visual tags or data to appear more accurate in hindsight. This chart maps the final, brutal leg of the drop. The system tracked the uninterrupted 380.4-point structural decay down to the absolute bottom at 23,241.00. It locked in this mapping by printing sequential deterministic markers, progressing systematically from point 3 down through point 7 as the floor gave out. An immutable audit trail proves exactly what the system knew and when it knew it. This degree of traceable logic is a mandatory engineering requirement for establishing institutional trust in algorithmic trading. The final evaluation comes from the Master Statistic Analyzer. This diagram details its post-market audit, which operates exclusively on closed-bar, mathematically confirmed telemetry from the collapsed week. The system's raw data presents a stark contrast in execution logic. Across the entire breakdown period, the architecture registered 47 strong bear counts versus exactly 4 logged bull counts. The final audit delivered a definitive mathematical proof regarding those 4 bullish signals. They yielded exactly a 0% win rate. Based on this math, the master system issued a behavioral protection directive. It officially determined that the long-side probabilistic edge was statistically non-existent, and that any counter-trend trades represented strictly adverse exposure. By subordinating probabilistic machine learning to explicit logic, a deterministic AI architecture secures capital against machine drift and human error throughout a structural collapse.